Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So it was a nice, slow, lazy summer, wasn't it? The market for almost a 2-month period, the S&P 500 index, within that period stayed within essentially a 40-point range for a couple of months. Very, very unusual amount of flat channeling market activity. And so you can almost get lulled into complacency. You can think, hey, this is going to go on forever. And it was last Friday was, let's see, I guess September 9th. And it was a lazy, warm Friday in the summer. No reason to think anything different was going to happen than has happened for the last 2 months in the market. And suddenly something happens, and something very big happens. And in fact, the market makes a bigger move in one day than it has made over the last basically 2 months. And we had this 42-point down day in the SPX and the beginning of volatility, which has continued into this week. So therefore, what does that teach us? It teaches us that the market can do, as I've quoted a number of times before, whatever the hell it wants to do, whenever the hell it wants to. The fact that the market has been trading in this tight trading range for months does not mean today it will continue to do that. It just means something happened in the past. It may or may not continue today. I was speaking to a trader who was on a plane on Friday. He figured, why would today be any different? It's Friday. Fridays have been real slow in the summer. Anyway, low volume, markets channeling in this tight channel. Why would anything different happen today? So he had some trades on. One particular trade was up about $6,000. He got on the plane on Friday, had no internet access, no ability to really deal with his trades. And he got off the plane and his trade was down something like $40,000 from being up $6,000. And that's a bummer. And I feel very badly for that trader. But it was, in fact, an avoidable situation. You've got to have a plan. You've got to have a contingency plan because you do not know when something will happen. And to prove it to you, how many of you woke up on September 11, 2001 and thought that 2 planes were about to collide into the World Trade Centers? And you of course did not think that. You did not believe that was going to happen today. It was probably the last thing in your mind. You would not have been able to contemplate that, but it happened. And so it happened, and the market, of course, had an extremely strong reaction to that and always will. So what I like to say to people is trade like an atom bomb is about to go off in Times Square in 5 minutes. And if you trade that way, you will always be prepared. Is it likely that an atom bomb will go off in Times Square in 5 minutes? No. Was it likely on September 11th that 2 planes were going to hit the World Trade Center? No, it wasn't likely, but it happened. And so you have to have a contingency plan. If you do not, you're gambling, and then you're not trading. You're not contemplating your trading as a business. You are thinking of it as something else, some kind of a recreation or gambling. But if you're serious about your business, you would no sooner not have a contingency plan for your trades as you would, not insuring your business, for example, and just hoping that you don't have a fire that burns down all your inventory and destroys your livelihood and the livelihood of all of your employees. You wouldn't dream of doing that. Well, you wouldn't dream of not being available, to handle your trades if something unexpected happens. Nobody expects a fire to burn their factory down, and nobody expects the market to move 42 points in one day when it hasn't moved outside of that range in 2 months. But these things happen. So you need a contingency plan. I'm going to give you a little list of possible contingency plans. I'm sure there are others out there, but these are ones that I have used myself personally, am aware of, and it's probably a fairly comprehensive list of the things you can do if you can't be in front of your screen. The easiest one, of course, is to take your trade off. I personally don't like to do this. I don't like the execution costs of a situation like that. In addition, the market, if the market's hasn't moved in 2 months, the overall likelihood is it probably wouldn't have moved on Friday either, but the likelihood didn't occur, did it? The unusual and unexpected thing occurred. So I would normally not take my trades off, but some people do that. It's not a bad practice, and if the market happens to move big time that day, you'll be very happy that you did. Then you can reposition. Another thing you can do is buy a straddle, which is basically an at-the-money, well, it depends on how you want to structure it, but you can structure an at-the-money position where you buy a call and a put, size it up according to your trade size, and pretty much freezes your trade so that if the market has a big move that day, you shouldn't get hurt too much. If the market does not have a big move that day, you will get hurt by the cost of the time decay on that straddle, but that's the cost of being unavailable for the market. There is going to be some cost to that. Another thing to do is to have a trading buddy. This is something that you should think about. Find someone else, maybe a member of the options tribe, another member of the options tribe who trades with a similar strategy, or even if they don't, it's a person who can simply follow instructions. It needs to be someone you trust, because you're going to probably have to give them your password and user ID credentials for your broker, and then allow them to go in and make changes on your trade if some certain things happen. You can trade off. I basically have a trading buddy in my life. When I go on vacation, he handles my stuff. When he's on vacation, I handle his stuff, and it works out great. So having a trading buddy is a very solid way to handle this problem. It's probably my preferred way. And then finally, you can also put, if you have a broker that allows the appropriate tools for you to put on contingency orders, then you can tell your broker, if the market price hits this amount, I want you to go in and buy this many puts, or some order like that. The problem with using contingency orders is if you don't get the market price right, then your order may never get filled, and since it's very hard to know exactly what a price will be, oftentimes you have to put in a market order, which means you'll get a lousy fill. And while certain brokers have some workarounds on this issue, I've never heard someone say it's been solved perfectly. So you can have contingency orders in on your trades as a way of solving this problem. It's not my preferred method, although I have used it and I have had contingency orders exercised. I'm not particularly thrilled with the fills I got, but at least it was protective of my trade, and here I am alive to trade another day. So let me reiterate. Trade like an atom bomb, could fall into Times Square in 5 minutes. Think of your trading every day as that risky, and then think about what precautions you would take so that if that did occur, you would be protected, and then take those precautions. That's what professional traders do. If you don't trade that way, you're a gambler, and you probably won't survive as a trader long term. If you do take those kind of precautions, it's a pain in the neck a lot of times, but it's just like buying insurance. Who wants to buy insurance? Who wants to put their seatbelt on? Who wants to lock their car up? No one wants to do any of these things. They're a hassle. It's inconvenient, but if you don't do it, something really bad can happen, and then you're going to really regret not having taken minor precautions that are ultimately minor inconveniences. So think like that, trade like a professional, and you'll live to trade another day. Thanks very much, and we'll see you next week.